Good morning, everyone, and thank you for joining us. Lost Illusion and Great Expectation is the name of our barometer that just we released this morning. And thank you to our economists for this effort to make it available just today for this webinar. So I am pleased to introduce today's speakers. Bruno de Mouras Fernandes, Marcos Carias, Seltem Iyigün, and Aroni Chaudhuri. So they are our region economists, and they will take care of our area. I just wanted to remind all of you that there will be a recorded version of this webinar, and also you will receive the presentation after our webinar. So I leave the floor to Bruno that will start with an outlook on the global economy. Thank you, Bruno. Thank you, all the economists, for your presentation.
Thank you very much, Antonella. So yes, the last time we made this webinar 3 months ago, basically we started to see some good news. And well, the fact is that the last months confirmed, I think, some of this good news. The first one is that we avoided the worst case scenario in terms of energy crisis. At the end, it's true, and we can see that, let's say, in the commodity prices, that the commodity prices went down, the natural gas prices went down. Why? Because there is no more fear of lack, let's say, of shortages of gas this year in Europe. Why? Well, once again, because of what we said in March, because thanks to, let's say, very high temperatures, very mild temperatures, but also the fact that some companies just decreased their production, the energy intensive companies like in metals, in paper, in chemicals in Europe have decreased their production this year, this winter, and so it allowed basically, let's say, European countries to save some gas and so to have comfortable reserves of gas. So basically, we think that maybe the major risk of the last year or the last winter, let's say, is okay for the next winter. We think that there will not be shortages of energy in the coming winter. But well, now the question is, let's say, what is the outlook for the prices? Because it's true, the prices went down, so it was a good news. We'll see then the impact on inflation. But we think, and also the markets think, when you look at the futures at the right-hand chart, that the market thinks if you want a deliver of gas for this winter or in 2024, you will have to pay 50 euros and not the 25, 30 euros we are recording now. So basically what they think is that first, the demand will increase because of, in Europe, of course, when winter is coming, basically the demand for gas increase, and also because the recovery in China will be gradual, but then China will accelerate, let's say, in the second half of 2023 and then in 2024. So basically, with more demand coming from China and also, of course, more demand in Europe, gas prices will rebound. We have to say that 50 euros looks, let's say, way lower than the prices we experienced in 2022, but we have to say that it's still way higher than the prices of 2019 and 2018. It was only 15 to 20 euros. So we'll have, let's say, high gas prices, but of course lower than it could have been in an energy crisis scenario. But then you have also the oil prices. Maybe Seltem will say a few words about that, about the OPEP cuts in production and so on. But basically, we expect also oil prices to rebound in the second half of the year and then in 2024. So you understood well. We think that basically energy prices went down. It was a good news, but then they will increase again in 2023 in the second half and then in 2024. And the issue here is that, well, the second good news I was about giving to you, let's say at a global level, is that in Eurozone and in the US, the inflation went down. It's true, definitely the peak is behind us. But then when you have a look at the composition there, I think is the issue. Why? Because the light blue bars, basically the energy contribution, is what made inflation skyrocket, let's say, last year, but also it's what made inflation decrease, let's say, over the last months, because you can see that the rest of the contributions are still really high and are still even increasing when we talk about goods, food, and also services. So basically the core inflation, when we exclude basically volatile components like energy or unprocessed food products, basically core inflation is really high and it's sticky. We are around 6% in the Eurozone, a bit lower in the US, but still well above the target of 2%. And then the question is, of course, if energy prices go up again, then it will mean that basically inflation will remain around, let's say, 4% at least at the end of 2023. And then it will be hard to make it really decrease towards 2% in the next couple of years. So even though inflation is decreasing, well, basically we see that central banks keep on raising interest rates. What you can see here is that, of course, you already know that central banks have raised interest rates a lot, very aggressive, tightening, but we think that basically they will continue to do so, at least in the Eurozone. We are expecting maybe one or maybe two additional hikes, so in June and then maybe in July again, and in the UK also. Because in the UK, we thought it was over, but at the end, inflation rebounded a bit. And so once again, we are thinking that the Bank of England will increase interest rates. The good news, maybe, let's say, if you can say it's a good news for the emerging countries, that we expect the Fed to now make a pause in their interest rates hikes. But, well, we have to say also that we expect the rate in the US to remain really high. We think the Fed will keep it unchanged, so at 5% for at least the rest of the year, and then even maybe the first quarter of 2024. Why? Because once again, inflation is sticky, so we have to try to maintain interest rates really high for quite long until the impact is felt and inflation go down. You can see, of course, at the right chart that basically interest rates on new loans to companies increase sharply. And we expect them, of course, as interest rates in the Eurozone will continue to increase. We expect interest rates on new loans to keep on rising. And of course, they will reach way, way, way higher levels than even during the last, let's say, sovereign debt crisis in 2011. And the other issue maybe is that the credit is more expensive, but also it's getting harder to get a credit. When you ask basically central banks in the Eurozone and in the US about their lending conditions, you can see that basically most of them are now tightening the conditions. So basically in the Euro area, in the US, they have tightened in the last quarter of 2022, but also they have tightened even further, even more in 2023. So it means basically that it will be harder for companies, for households to get credit. And so we expect definitely right now a slowdown in activity. And we are already seeing that basically in the Eurozone, new loans to companies, they are decreasing. We are at negative new loans, new production. So definitely we can see there the first impact, let's say, of the monetary policy. We have to think that there is always a lag between the moment where the central banks tighten and then when it's felt by the economic, let's say, by the economy. So it means that basically we expect now the full impact to be totally felt in Q4 and in Q1 of 2024. So basically over the upcoming quarters, we think that domestic activity will be subdued. Why? Because what we just talked about, because of the monetary tightening in the US and in the Euro area. So here are our GDP growth forecast for 2023 and maybe more interesting 2024. What you can see is that basically we expect the same growth, roughly the same growth in 2024 at a global level, but maybe let's say first we have to say it's a growth that is still positive, so we do not expect, let's say, a major crisis in our central scenario, but we have to say that it's a lower growth than before the pandemic. You can see we are still way lower, and also it's a growth that basically will be driven basically by the emerging countries. Because when you have a look at our GDP growth forecast for the European economies, we think that basically the GDP growth will remain roughly the same that in 2023, because once again of what I mentioned, the fact that monetary policy will produce its impact, its full impact over the coming quarters. Also, for instance, a country like Spain is doing quite well, it's true, but also because it was lagging behind the rest of the countries since 2021 and 2022, because, let's say, of a lagged recovery in tourism. But now tourism is recovering, but well, in Spain, as in the rest of the Eurozone, basically, household consumption has decreased in Q1, also in the last quarter of 2022. So subdued domestic demand, but well, tourism is recovering. So basically, we have still high growth, and we think it will continue in 2024. But well, for the rest, we are behind the potential, quite low growth, let's say, in the Eurozone and also in the UK. In the US, you can see also we expect sharp slowdown because of what I mentioned previously. In China, as we expect recovery, let's say, to get a bit more firm, let's say a bit more strong and solid over the next quarters, we think that then the country will accelerate a bit, or let's say remain below 5%, it's true, even though it's the target, but at the same time, let's say to post quite solid growth, like for India, for instance. So emerging countries will do quite well, let's say a bit better than advanced economies. And so this is why when now I show you our country risk assessment upgrades and downgrades for this quarter that have just been released this morning, what you can see is that there is more light blue than dark blue. Why? Because more upgrades finally than downgrades. We have posted basically 13 upgrades this quarter and only 2 downgrades. But well, most of the upgrades are in emerging countries. It's what I was mentioning. Most of them are emerging countries, commodity exporters, like for instance, Saudi Arabia, Qatar, also Nigeria, Kazakhstan, also some Asian economies that will benefit from, let's say, more and more Chinese tourists, let's say, Philippines, Malaysia, for instance. But well, the rest of the economists will, of course, talk about their region and their countries in their region. Maybe just a few words to say that it's true, emerging countries are doing better, but at the same time, we have to keep in mind that some, let's say, some pockets of vulnerability remains, because of course, I mentioned that interest rates are higher. We have a tighter global financing conditions for countries, also not only for companies. And so some companies, some emerging countries are struggling basically to repay their external debt. They are facing, let's say, currency reserve crisis, or at least difficulties, like Kenya and Bolivia. That's why we have downgraded these countries, just to say that basically the outlook is not that bad. It's quite good, let's say, for some emerging countries, but well, we are still to monitor the situation, because some countries will still be affected by this adverse environment of high financing costs. And well, just to finish my part, basically here are the sector risk assessment in Western Europe. Maybe 3 key messages. The first one is that, well, we keep on downgrading the construction because the environment is getting more and more adverse. We are seeing definitely very negative results in France, in Germany. At the same time, pharmaceutical sectors basically everywhere is not that low risk sector because of high costs. Once again, also because basically governments are trying to cut spending, so it means basically low revenues and high costs. So maybe a more complicated, let's say, situation for the pharmaceutical sector. And then in the transport sector, we are, you can see, upgrading. So good news for the transport sector. Why? Well, thanks to higher, let's say, aerospace exports, and also thanks to tourism. We think that tourism will keep on recovering. So basically for air transport, it's good news. And basically, we think that the transport is not anymore a very high-risk sector in most of European countries, but yes, still high-risk sector. Like for the automotive, as you can see, it's true. I think we have reached the bottom, but well, we are still far from pre-pandemic levels. So we are in a high risk, but not very high risk anymore. And now I leave the floor to Marcos that will talk about Italy and Greece.
Thank you, Bruno. So thank you everyone for being here. We'll give this update on Southern Europe, beginning by the third largest economy in Europe, Italy. And there is much to be said about Italy. First, that we had this positive surprise on the Q1 GDP, plus 0.5% on the quarter-on-quarter. Everyone, including me, we were expecting more stagnant Q1 GDP. And so because especially this resilience of domestic demand and of consumption, this is motivating across the board, across all institutions that make forecasts, upward revisions of 2023 figures towards a more like 1%. What does this say about the state of the Italian economy? Is that we are seeing a persistent decoupling of the dynamism of industry and of services, particularly tourism. So on the one hand, we have tourism and also employment and consumption on the consumer side that is staying very healthy. And on the other side, where we look at figures such as industrial production or the manufacturing PMI, we're seeing increase in weakness. So what is at play here is factors like employment, which see unemployment declining to levels that we have not seen since before the global financial crisis, 7.8% as of the latest reading. We are getting from the aggregate European figures that wage growth is also accelerating, and Italy is not an exception. We are also aware that the households are drawing down on their savings, that they accumulated substantial savings during the pandemic and are drawing down on the savings rate. And all of this is supporting consumption. What should we expect in the next couple of quarters? Broadly speaking, an economy that remains resilient, that is not expected to be as dynamic as it was in Q1. So there are still factors that will support growth. Notably, it's important to take into account that Italian companies have been drawing down on inventories for a while. And so it is expected that they might rebuild a little bit of inventories throughout the year, and this, of course, will be some boost to production. Also, we know that Italy, as the rest of Southern Europe, is benefiting from this change in consumer patterns, in consumer behavior that is benefiting services and tourism at the expense of manufactured goods. But of course, we know that the main export destination of Italy is Germany. Also, France is an important export destination, and these are economies that are being a little bit more sluggish, and so this is being noticed on the export side. As Bruno said, further ahead, going into 2024, we should be vigilant to the effects of the credit crunch, of the tightening of financial conditions that might be more important. Thank you. So on this graph on the left, we see the PMI index, this survey indicator that tells us how businesses are seeing their overall conditions for the next few months. And we see that this sentiment is negative on the manufacturing side, but broadly positive on the services side, and this is a manifestation of the services that are really being the engine of the Italian economy. Construction has been in negative territory for some months now, remains in this territory as of the latest reading. But what we are seeing in construction is that we had this issue with the super bonus, with the tax incentives that have been that have been canceled recently, and they are taking a little bit more time than expected to materialize. We are not seeing yet the full effect, so we should, of course, remain vigilant in line with what Bruno said on the risk assessments on the construction sector, as we are also seeing the trends in the real estate market, housing prices going down, is something to be monitored. On the right-hand side, we have the hard figures, industrial production and retail sales, and here again the same story. Industrial production remain in contractionary territory for the last few months, so a little bit signaling a little bit of slowing of activity ahead. What you have here on the left-hand side is the application for Italy of the graph of the financial conditions and lending standards that Bruno showed for the euro area earlier. So what does this signal is that we are still seeing Italian banks tighten financial conditions, even if, as shown by the latest reading, it's a bit slow. This tightening of financial conditions is slowing down, but we are still having banks being more restrictive than they have been in recent years. At the same time, we have, as is the same pattern elsewhere in Europe, headline inflation going down, mostly on the back of energy disinflation. Also, core inflation, which again is the inflation without food and energy, slowly slowing down very gradually, which signals that this inflation, even if it's slowing down, it remains high, and we have to, like Bruno said, like remain vigilant to the developments of the global energy markets going into the end of the year. When it comes to insolvencies, an interesting data point is the Q1 insolvency data, where we have seen for the first time the first material increase, I would say, in insolvencies of the last few years. We know that this is a period where insolvencies have been historically very low. And so we have to remain vigilant for the Q2 numbers to see if this consolidates, if this is indeed a stable inflection of the insolvency curve. I interpret this as being a lagged effect of what we have here on the right-hand side. This blue curve on the right-hand side is a survey data that Istat conducts, asking companies how they see their liquidity situation, and we have seen this degradation of the liquidity situation all throughout 2022. However, it was also a year where the pandemic cash buffers of all the money that they got from the state was still in play. Is also, as we know, a year where the economy was still fairly resilient. So we know that this solvency phenomenon is a lagged effect of all of this phenomenon that play on the liquidity of firms, cost, revenue, public contribution, public assistance. So what we are seeing in insolvencies in other countries is that this insolvency suppression is stable until it is not. In France, it started at the middle of the last year. In UK and in Spain, it started even earlier. So we could be going into this normalization process that has started for insolvencies in Italy. Finally, a few words on Greece, which is the overperformer, which is along with Ireland, probably one of the most dynamic economies in Europe. So since tourism is such a bigger part of the economy in this country, around 20% of GDP, it is obviously benefiting much more from this tourism dividend, as manifest in the very dynamic growth rhythm of 6%, 6.1% in 2022. As other countries, growth will slow down, but slow down to, let's say, a slightly more dynamic growth rates of around 2% in 2023 and 2024. So this is a country that is also being supported by European funds, resilience recovery funds, which are also higher in Greece as a share of GDP compared to other countries. We had a little bit of doubts recently on the political side because it was going into elections, because since there is not the 50 for these elections that just happened now in May, there's not the 50 bonus, the 50 lawmaker bonus. We were going to go into a second snap election that is happening in June, but actually, since the incumbent New Democracy Party got such an unexpected good result in this first round of elections, we now think it's pretty sure that they will be able to form a majority, a stable majority, unless something very unexpected happens in this second round of elections. So some political uncertainty has gone out of the way. There will be stability in government and stability in policy making, and so Greece is looking like a country that will continue to make progress in terms of development, in terms of growth. The manufacturing PMI is showing that activity, although it's going a little bit slowing down, softening, still remains in expansionary territory. So we can expect another good year for the Greek economy.
Thank you very much.
With this, I leave the floor to Seltem. Sorry.
Thank you very much. We leave the floor to Seltem, that she's going to present Turkey and Middle East outlook.
Thank you so much, everybody, and welcome to the webinar again. So I'll start the presentation with Turkey. So as you all know, Turkey had a peaceful period of elections, and President Mr. Erdogan won the presidential election while his alliance took the majority in the parliament. The fact that Mr. Erdogan has secured a third term as president has lowered political risks in Turkey. And the new cabinet of the president reflects a likely return to more orthodox economy policies in the upcoming period, and consequently, the news has been welcomed by markets. In the first graph, you can see that the risk premium of Turkey, I mean, its 5-year dollar CDS has declined below 500 level. And the new finance minister stressed that it's Turkey's commitment to price stability and fiscal discipline. And even before the elections, you can see on the second chart that financial conditions in Turkey have been tightened by banks, as you can see through the loan rates and deposit rates. And we now expect a gradual rate hike from the central bank to a more compatible level with the inflation, and an easing of recently introduced micro and macro prudential measures. This may weigh on loan growth, causing a slowdown in the growth performance of the economy. So we consider that the central bank concluded its monetary easing process in May, and so it delivered a total of 550 basis points rate cuts within the last 12 months. So we expect the central bank to deliver rate hikes within the rest of the year, which will bring the benchmark policy rate to a band between 25 to 30% by end year. And we still expect Turkey's economy to grow by 3.5% this year from a year earlier. If we can move on to the next slide, please. Okay, so in May, annual inflation fell as low as to 39%, thanks to the implementation of zero price method by the Statistics Office for natural gas prices. In the upcoming months, the government's decision to provide freely 25 cubic meters of natural gas to households will help to reduce inflationary pressures. However, the gradual depreciation of the lira and the stubbornly high inflation in the service sector coupled with the expected minimum wage adjustment in July, will feed into prices in the rest of the year. And so consequently, we still expect the average inflation to stand around 40% for Turkey by the end of the year. And another biggest and important challenge for the new economic team will be about increasing the central bank's international reserves. The central bank net reserves dropped to their lowest level since the beginning of 2022, and since the beginning of the year, the total reserves declined by around $32 billion to minus $4.4 billion in May. So if we can move on to the next slide, please. Okay, coming to the Middle East, we expect unfavorable base effect, weaker domestic demand and external demand, and lower hydrocarbon production will weigh on economic activity this year across the region. But still, private consumption is expected to remain as the key driver of the economic growth. Overall, we expect the growth performance to decline somewhere between 2.5 and 3 percentage points around across the GCC region, driven by anticipated reduction in the oil hydrocarbon output. However, still investments will continue to grow, particularly in countries like Saudi Arabia and the United Arab Emirates, even in Qatar, on the back of their long-term visionary programs and mega project and digital transformation plans. So far, the preliminary indicators such as the PMI show that growth in the non-oil economy was doing good. So we will come to this in the following slide. Thank you. So as you can see in the first chart, the operational conditions in the non-oil sector in almost all the countries, there is an improvement actually in the overall operational conditions. For example, in Saudi Arabia, we saw that in May, mainly the rising demand, market demand led by an increase in economic activity supported the improvement in the non-oil economy. So we saw that there was an increase in the new orders, and companies are still optimistic about their business expectation within the next 12 months. So this is almost the same case for the United Arab Emirates and Qatar. However, when we look on the oil front of the economy, export revenues are seen to fall by around 24% this year on an annual basis, for a decline in production by nearly 2%. This will compensate the relatively positive impact coming from this strength of the non-oil economy. So this is because actually despite these diversification efforts, oil accounts still for around 40% of GDP and more than 70% of fiscal revenues across the region. And you know that recently, OPEC countries, together with OPEC Plus, have decided to cut an additional 1.116 million barrels per day of their oil from their oil supply that started in May 2023. This came after Russia announced actually a voluntary cut. Plus, you know that recently Saudi Arabia also announced that it would cut by nearly 1 million barrels per day from its oil production. So if we take all this, we see that members of the GCC are providing the bulk of this latest rounds of cuts. So, for example, Saudi Arabia will account for around 45% of this reduction decisions, while the United Arab Emirates and Kuwait around 10 to 12%. So this will have an impact on the growth performances, but also on the oil economy growth in those countries. However, we expect this will be compensated by the positive operational conditions in the non-oil economies. So if we can move on to the next slide, please. So this is going to be the last slide. We see that inflationary pressures in Israel have not been really stabilized yet, and the central bank raised its policy rate by another 25 basis points to 4.75%. And you can see in the first graph that annual inflation stays above the upper band of the central bank inflation target at 5%. So economic activity, however, remains strong. But some preliminary indicators suggest that there was a slight moderation in the activity. So GDP expanded by 2.5% in annual terms in the first quarter, and we expect the growth rate of Israel is to 3% this year, compared with 6.5% last year. And when we look at the employment rate, we see that there is a strength in the labor market as well, as the economy is now close to its full employment. And we saw that unemployment rate in Israel fell to 3.6% in April, compared with 3.9% a month earlier. That's why we consider that this tightness in the labor market will also encourage the central bank to give another rate hike by around 0.25%. This will bring the policy rates to 5%, and then we expect the Central Bank of Israel to adopt a wait-and-see stance until the end of this year. So thank you so much, and I will leave the floor to Aroni.
Thanks, Seltem. Hi, everyone. So for the part on Africa, I think that I will fully agree with Bruno in saying that it's a region that is quite representative of emerging economies, because at the same time you've got a lot of dynamism, but on the other hand, you have a number of countries that are now at high risk of debt distress or of balance of payment crisis. So it's quite representative. If we look at the growth outlook, you can see that actually there was a quite significant slowdown on the African continent in 2023, but that is mainly due to the very poor performance of two major economies in South Africa and Egypt, as well as Ghana, which is quite important. And so, you know, the slight rebound in 2024 is also because there will be a slight rebound in these economies. So if we look at the aggregated level, basically we can say that, like at the global level, you know, growth in Africa is relatively stable, but it's still below potential, because the potential is above 4% normally. And you know, there are two major you know, risks that I see at this moment for the year to come. One, and we said it, it's the risk of the funding squeeze. It's the debt crisis, the balance of payment crisis that obviously affect economic growth through you know, just the effects that they have in terms of fiscal consolidation and monetary tightening. Secondly, and I think that it's important to note, is that the changing weather patterns, we are going into a drier world that is not at all good for, you know, African economies, which are very, very sensitive to climate risks. And in fact, that can be seen in the inflation rates over, you know, most of the economies in the continent, which are receding much slower, even in terms of headline, than in advanced economies, because it's sustained by food inflation. Because you know, the harvests were not good last year, and some countries are really dependent on having good rainfall this year. which is normally, less likely because the weather is drier. So this is also a major risk, and why there might be, quite some volatility in the growth performances of some economies that are particularly dependent on their agricultural sector. That being said, I mean, there is also, as I said, a lot of dynamism. The commodity exporters are going to continue to fare well. This quarter, we upgraded 4 countries in Africa, and we downgraded only 1. Niger and Nigeria, especially, that we upgraded in C was because hydrocarbon prices are still well oriented, and despite some production capacity constraint, it will still be a support to growth. As you can see here, the large oil exporters are all above their pre-crisis trends, although the growth rates might seem low in relative to more dynamic economies. And then you have obviously the dynamism of countries like such as Tanzania that we upgraded into the B category, closer to Cote d'Ivoire and Senegal in terms of growth structure and growth outlook. And Ethiopia is still faring very well despite the war, which also shows that sometimes there is a decoupling between economic growth performance and political risk. It's not always that the two will move together. And finally, we have Morocco, which is supposed to rebound from a poor agricultural season and which will continue to do well. We'll speak about that a bit later. However, I mean, I would like to, if you can go on to the next slide, Bruno, please. I would like to talk about Kenya because this is the country that we are downgrading this quarter. It is really in the sequence. It's in the sequence of Egypt. It's in the sequence of Ghana. Now it's Kenya. It's these quite large African economies, quite dynamic pre-crisis African economies, but that's had an excessive use to public investment as a growth driver that are now facing these constraints in terms of debt sustainability. For Kenya in particular, as you can see that Kenya's debt structure basically is relatively balanced in terms of domestic and external debt. So the issue with Kenya right now is on its external debt. The reason being that, one, Kenya is already under IMF assistance, so the pressures that they're facing right now would mean that they would have to probably go into a restructuring. And two, the reason is that the foreign exchange reserves of Kenya are still under pressure because of the combined effects of the war in Ukraine, of capital outflows. And so since they have an important share of their debt that is external, their external debt service is extremely high. And that is why their reserves are under pressure. That is why also the government is going to have to make significant adjustments. They have already gone into fiscal consolidation, but they have to do more. Last month there was a tough decision to make between paying public wages and servicing the external debt. And with the payment with the maturing of a $2 billion Euro bond in 2024, that is when we will see if the levels of reserves are sufficient to ensure that that Kenya does not have to default on its external debt. It's quite likely. It's quite likely because shoring up reserves is extremely difficult in this world, especially for countries that have current account deficits like Kenya, for instance, and reliant obviously on their energy imports, with energy prices likely to increase. So yet another example. Next time in the next webinar, I might be talking about Ethiopia because that's one of the other countries that's on the list. So just to say that this sequencing is going to continue as long as interest rates at the global level remain high, because this funding squeeze will continue. There is another country I would like to talk about, one again at the brink, I think, of a default in terms of external debt, and that is Tunisia. For Tunisia, the situation is, I think, is slightly different in the sense that here it really shows how lengthy negotiations and how political rhetorics and risk can affect the negotiations over an IMF funding or a restructuring of the debt. The problem in Tunisia is that just like Kenya, I mean, it accumulated external debt to the point where the reserves were not sufficient to be able to cover all the external financing needs. But normally Tunisia would have been a country which would have been, it would have easily obtained financing from the IMF in the pre-pandemic world, because it's a country that always enjoyed a lot of support from both its Western allies as well as the international organizations. Now the issue being that with the authoritarian shift in the country, with the rhetoric that is used by the president, some of these countries are now voicing concerns, like the US, who vetoed one of the agreements of principle, like the World Bank, who pulled out of their negotiations on their side because of comments on migrants. So that is why financing that should have been obtained quite easily is now being lengthened. And the issue is that, and here you can see it on the chart on the right, it is just a simple graph that shows the balance between financing needs and financing sources, and which has to be, if there's a mismatch, it has to be used by the use of reserves. And so if nothing happens, then Tunisia basically will be depleted of its reserve by mid-2024. That scenario is very unlikely, which means that either they have to obtain the financing from the IMF or they have to default on their external debt. That's kind of the only way possible. And that is why we think that this is one other country that is on this list and that is nearing a very critical stage. To finish with, as I like to finish my presentations with always positive thoughts, so I want to talk about a country that is doing more positively, and really a kind of the opposite mirror of Tunisia, being Morocco. First of all, because Morocco is rebounding strongly, because the rainfall is supposed to be a bit better, and it's all the tourism is also recovering quite strongly compared with Tunisia, for instance. Tunisia and Morocco being the two destinations, especially for European tourists. And as you can see, in terms of their external imbalances, well, they're starting to correct, notably because the services surplus through tourism is increasing, and Morocco is a country that always has strong remittances from its diaspora. And on the other side, there is also the fact that while having imbalances, Morocco doesn't really have a problem in financing them, because be it on the debt, which is mostly public, and Morocco public and domestic and in local currency, Morocco has a very liquid and solid banking sector, so there's no real problem to finance that part of the debt. And in terms of external financing, it's a country that is generally well seen by investors. It attracts a lot of FDI here. For instance, in 2022, you can see the large FDI in the manufacturing sector, which is through the phosphate industry, basically. But it also attracts FDI in other industries. It's a stable regime, and so it doesn't have the same constraints on financing as most other African economies have, and that is why it is this stability puts it in an advantageous position concerning these problems of debt sustainability and balance of payment crisis. And also one interesting thing to say about Morocco relative to the African continent is that it's one of the countries that is a point of entry into Africa now, especially West Africa, through its banking sector. So there is also a lot of outward FDI from Morocco into the African continent, and links that are being created between the rest of the world, this country, and West Africa in particular. So I'll end on that, and I think we'll go to the question. Thank you for listening.
Thank you very much for your presentation. Very interesting for this outlook on different points. We have good news. We have some point of attention. GDP is going well in many countries, but not at the level of pre-pandemic. We have some point of attention also in some of the countries we have our branch. Let's go to the Q&A, and I will start with Bruno, head of macroeconomic research. So what is your outlook for the upcoming snap election in Spain, Bruno?
Well, for the moment, it's quite uncertain, because it's true. The government, so the Socialist Party, has basically lost the regional and local elections. It's true, it was a huge wave from, let's say, the right party, but at the same time also the far right. And so after this defeat, this heavy defeat, the government has decided to basically announce snap elections. They were supposed to be held, let's say, in December. Right now, it will be in 23 of July. It's still uncertain, because it's true. Now we are definitely seeing the resurgence of the right. Also, let's say, an increase of the far right. So we could have, let's say, a government with, let's say, an alliance, an agreement, a coalition between the right and the far right. But it's not sure that it will be enough to gather, let's say, the absolute majority, because then it will depend on the left and the far left. If the far left will also manage to do a coalition and to only present one candidate from the far left, that could then, let's say, gather a majority of seats with the left and some regionalist parties. So for the moment, very uncertain. in any case, it's quite likely that, well, if we keep basically the same government of the left and the far left with some regionalist parties, well, it will not change that much the economic policy. If we move to some right and far right coalition, of course, this coalition would be led by the right. So let's say more business friendly, maybe measures and policy. So in any case, as let's say it will be a coalition led by the Socialist Party or the right party, we think that basically it will be quite stable, let's say business friendly measures. And so at the end, we do not expect a major impact on the economic performance of Spain, that will still, let's say, continue to rebound thanks to tourism and so on. And so yes, uncertainty, huge uncertainty. It could be that basically the results of the election could be very tight. So at the end, we could have maybe lengthy negotiations. But in any case, we do not think that it would have, let's say, a huge or a major impact in any case on the economic performance of the country.
Thank you, Bruno. From an election to another. So I jump to Seltem. We just had the election in Turkey. What are the expectations on Turkey's macroeconomic policies after this election?
Yeah, it seems that the new economic team is in favor of more orthodox policies. So as a first result, we can expect the central bank to start delivering rate hikes in order to bring the policy rate to a more compatible level with the current inflation, which stands at 39%. So by the end of the year, we consider that given our expectations that the inflationary pressures will remain elevated, we consider that the policy rate may settle somewhere between 25 to 30%. So we currently see the lira depreciates versus the foreign currencies gradually. So this can continue to up until a level that would that would represent an equilibrium between the growth, inflation, and also the external trade. So we can expect some tax hikes in the upcoming months because it seems that the new economic team would be more in favor of fiscal discipline, which was already a part of Turkey's long-term story. So we don't expect Turkey will witness any difficulties while attending its budget deficit to GDP forecast at 3.5%. However, of course, there are some current transfers that need to be done in order to support the reconstruction activities in the earthquake areas. But except these spendings, we expect the government may follow tighter fiscal policy in the upcoming period. Thank you.
Thank you, Seltem. In the past months, we listen to a word that you would like not to listen anymore, the credit crunch. So, Marcos, why is the credit crunch not visible in the GDP figures?
Yeah, it's important to always take into account that when it comes to monetary policy and when it comes to bank lending, things take a while. It doesn't happen overnight. You know, the central banks started tightening aggressively all across last year, and we are nearing the end of that tightening cycle. And there are several factors that make this process a bit slow. Like banks, they do not immediately and with the same strength transmit their higher, let's say, funding costs on their liability side to their asset side, because they are worried about market share issues. It's a very competitive sector because they have become very entrenched in the economy through these government policies that we saw during the pandemic. You know, they were very active in supporting endangered firms through guaranteed loans and all of this. So there's a bit of like, we're all in this together now kind of feeling. Also, since European banks are better regulated overall than American banks, they were more stable and they are more capable of suffering the rate pressures of without transmitting that into the credit supply. That being said, it is a slow process, but it is going in that credit contraction direction. That's why I agree with Bruno in the fact that you know, the timing is difficult to get when exactly we will start seeing this wholeheartedly in the GDP figures. But towards the end of the year and the beginning of next year, I think at this moment is a good time to be vigilant, because of course there is also all of these liquidity buffers that are progressively drying, be that on the consumer side or be that on the business side. And so this is despite the fact that growth figures have been good so far, an area of vigilance.
Thank you, Marcos. Let's go to Aroni. Aroni, is the debt restructuring with the common framework for African countries advances as it should, or not?
Well, the short answer is no, it's not advancing as it should. No, just to give a bit of context, I mean, there are 4 countries currently under the common framework. So there's Ethiopia, Chad, Zambia, and Ghana. None of these restructurings have, led to, a favorable outcome. They're still all in the process. Some of them have been going on for years. Ghana is the most recent one, and to be frank, it's perhaps the one in which, people are putting a bit more faith that it will lead to something. The main reason is because in this common framework, there are disagreements between the multilaterals, the bilateral lenders, mainly China, but also others, as well as the private creditors on how the haircut, should be decided on. China at the beginning wanted the multilaterals who are exempt of the restructuring as preferential status to be part of the restructuring, which then they drew back on because the IMF and the other multilaterals said that if they were, to restructure as well, they could not give preferential rates, and so the cost of financing would even increase. So all of these disagreements make the process very lengthy. There is also the fact that right now there is no obligation or rules that force private creditors to align to at least some part of the agreement on the haircut with the bilaterals. There were some talks of that, I think, in the US as well. So basically, it's the fact that the framework exists, but the rules within it are quite unclear. There's a lot of opacity on the different types of lending that are done to China, hidden debts, etc. So even in the case of Ghana, which is really a restructuring up until now, I would say, to obtain the IMF package, which was done by the books, because Ghana restructured its domestic debt first with its domestic creditors with the first haircut. Then they went into the common framework to discuss the haircut on the external debt. And obviously, for a country that is has stable and solid institutions, stable political environment, so they really did the process as it should be. And even in the case of Ghana, it's becoming a bit lengthy. It was supposed to be faster. So that's why I think that for now it's not functioning. It probably needs a bit of tweaking around the edges. It needs some more comprehensive rules for all the creditors, and especially at some point an amount of a haircut that everyone can agree on, or everyone is bound to agree on, which is the difficult part here, because you can't really force private creditors unless in this framework you implement a rule which says that, okay, if we arrive at this amount of a haircut with the bilaterals, then you private creditors have to take it. That's the rule. So I think that that's kind of what it might come to, because otherwise it won't work. There was a lot of hope in the common framework that this would be the tool to restructure debt, because we have more and more debt restructuring coming, and with some system that is functional is needed. But right now it hasn't proven that it is very functional in terms of time frames.
Thank you, Aroni. I will give again the word to Bruno for some last words. We have some questions we are going to answer privately. Bruno, we have also as a guest today some entrepreneurs, some agents, people that stay in the market that would like to have some advice at the economic level, because at the end we are used to be in a really changing environment where the risk is must taken into account. So just at the economy level, what are your advice for the next months?
Well, very tough question. No, I think that the most important, I think, is to identify the risks, and that's why, and then to be prepared for everything, for any scenario, and to, of course, not to say, this is a risk, a major risk, so I mean, we are sure it will materialize, so basically we have to be prepared for the worst. No, but basically what we are saying is that it's true, the worst has been avoided, but now, of course, we still have some challenges ahead of us. So, of course, we have to navigate in the uncertainty. We know that it's a very uncertain world with geopolitical tensions. Also, well, in terms of economy, of course, we are not sure, as Marco said, what will be exact the timing, of the monetary policy impact and so on. But well, I think it's just, to identify the risk, and then once you have identified it, then just to be prepared, to be agile, and to try to have different scenarios, and to be ready, to switch from one scenario to another. So yes, this is why we are trying to do, to try to, as I say, to assess as well as possible, and then to change our scenario, and then to identify, yes, what could be the risk, to then be able to be agile and to, to switch to one plan to another. And yeah, well, I think, I'm not sure this is the best advice, but anyway, well.
But no, it's the best, because of course we are in the sector since many years, and we saw that economy changes, and sometimes with unexpected situation like the inflation. No? We were used to see the inflation in some countries, but suddenly grow up in a really tough way also in Europe and the USA. So
yeah,
this
the
is
war,
the best.
it's true, the war, the pandemic. I mean, I think that when you are economist, you get humble because you are sometimes wrong, or at least you do not see everything coming. So then it's just about, defining maybe some scenarios, and then to change and to adapt, and to be agile.
Your work is really important also for our now job as a credit insurance, as you assess all the countries and put the base of our credit limit evaluation. And it's really important to tell to everyone that we just released the new barometer, that it will be available on all the website. And also we are going to release in all our countries, so in all our more than 60 countries, our press release in order to inform our market. So that's publication are really well accepted by the market. So and also this webinar, and we will have another one in autumn. So I invite all of you to follow us. And I remind we are going to send the presentation and the recorded version of the webinar to everyone. I would like to really thank you, Bruno, Aroni, Marco, Seltem, for their daily work for this webinar. Thank you very much.
Thank you very much. Goodbye, everyone.
Thank you very much. Goodbye, everyone.
Bye-bye.